All right, so this is where we left off. So we just talked about the assumptions and we just talked about basic principles. Now, the last thing that we're going to talk about is the constraints and conventions. Okay. So the first one is going to be materiality convention. So basically what this pretty much says is if an item has significance or if it has importance enough that it should be reported. If not, then it is ignored. So what does this even mean? Pretty much it's like any transaction, like what the one thing that we would need to understand too is this also like it's related to the other principles as well. If this transaction is significant enough to report it. So again, if things don't have a dollar value to it, obviously those things are going to not be significant enough because there's just no dollar value in it. So what materiality does is it kind of poses as, is it worth it, or is there enough information about it to actually be able to record it? So that's what it means by significance. Now, of course, nowadays, we put a dollar value to pretty much everything. But there's also certain things that hold value to us that we put a price value, but it really isn't worth anything to anybody else. So that's what materiality is. It's basically, does this item hold a value that you can put a dollar value to it, and is it significant enough to report? If it isn't, then it is ignored. Okay, so an example that I use is like things like if you own, for example, like gold, right? Gold does have a price value to it. However, it's not easily obtainable. Of course, the gold value, just like the dollar bill, loses its value over time. And things like precious metals, right? We actually have to measure it and actually put a dollar value to it. So, for example, those that are just so precious that don't have a dollar value to it because it's just, we can't put a price on it, then it's going to be considered insignificant enough to record. So, yes. So things that typically, that hold value but you can't put a price tag on it is pretty much materiality. Okay. Second thing I'm going to talk about is going to be the cost benefit convention. So this is actually more geared towards cost accounting, okay? Because this involves with is providing. So here's the definition. So is providing the financial statements. Is it going to be worth it if it costs us a lot of money to produce it, to provide it to the public? So again, oftentimes when we look at our financial statements, the main goal is to be attractive for other investors who are interested in wanting to buy from us. So this is for example, for many corporations, right? If you can release your financial statement saying that my company is super, super profitable, we want you to invest in our company. So by you becoming a shareholder, you could be part of the success. So things like that, they kind of gear towards that kind of thing. But of course, with corporations, they need to spend a lot of money to produce these financial statements. And again, with professional help, and what the Big Four does for those major corporations is they don't do it for a small price value, especially again if they're a corporation that deals with millions of transactions per day. You can see how exhausting that can be. Okay. Another example of this cost benefit is, again, if you are a t-shirt company, is it going to, and you need to produce a product soon. The option is, well, if I were to do it in the United States, right, have it printed, have it done here in the United States, it's going to cost me a lot more money because of the convenience, and plus we charge a premium for producing things in America. Or is it and then once I produce it in America, the turnover rate is going to be a lot more quicker because it's already in the United States. It could take 24 hours. So that means I can go ahead and turn around and sell the shirt and make money off of it. Or is it actually more worth it if I just ship it overseas, have it done for a cheaper cost, and but the only turnaround there is it's going to be sent to me a week or 2 weeks later. But I'd be able to profit more money because I can sell it for the same price, and I wouldn't have to. It would benefit me because it would I would make more profits. So that's pretty much what that is, a cost benefit. It's just weighing out your options and seeing which one actually you're just weighing out the cost of the item and what benefits it has for you. So this kind of goes hand in hand with number 3, which is the conservationism, which is basically utilizing those alternatives and deciding which alternative is going to be least likely to overstate or understate your assets or your statements. So in this case is which one's gonna, not only are you weighing the cost and the benefits against each other, you're gonna choose an alternative that's going to least likely cause you obviously less or more trouble along the way. And that's the conservation, okay? So now that those are talked about, the last one that I have left is going to be industry practices. Now what industry practices actually does is, this is where I talked about this also briefly, is that when you are releasing your financial statements, the real main goal of a financial statement is you want to look comparable to another person or another business in the same industry, or if not in a similar industry, okay? So if you're producing financial statements and you're comparing them against all other mom and pop shops, or you're just comparing to someone that's in your same industry. So if you're a coffee shop, you're going to compare to other local coffee shops. So that's exactly what the industry practices actually does. It actually allows for kind of like conformity when it comes to standardizing something. So for example, again, financial reports. If a corporation, so I'm going to use Starbucks for example. If let's say I'm another coffee company, another corporated coffee company, and I see that Starbucks is doing something super successful because they're in my same industry. What I can do is I'm going to compare my financial statements and see what they're reporting and what they're doing right. And usually the general rule of thumb is you tend to gear towards that same kind of flow by, making your financial statements look a lot similar to Starbucks. Maybe they're doing more advertising, or they're spending most of their money doing marketing online or something, or they have a lot of promotions. So that kind of thing is generally, rule of thumb is you kind of want to compare yourself to other people that are in your same industry so you can be in the same playing field as the same company. So again, with that being said, if you are in that industry and you're trying to make yourself profitable or make yourself more, desirable for investments, then general rule of thumb is you tend to follow people in the same industry to kind of build yourself around it, to be able to do something like that. So that is going to be constraints and conservations, okay? Or I'm sorry, conventions. Now, any questions in regards to these 4 things here? These 4 are more geared towards when you're running a business for long term. This is more for projections or more for bettering yourself as a company and making those executive decisions. So this particular section, I'm not going to test you on it, where we're going to do an exercise on it, but I'm not going to test you on it. What I primarily want you guys to know the most is going to be the assumptions and the basic principles, because these 2 are what's going to be the underlying rules and principles that you're going to be utilizing when it comes to journalizing and recording your transactions. Where your constraints and stuff like that, this is more for managing and making projections, making executive decisions that don't really necessarily deal with your main priority, which is journalizing. Okay, but is there any questions in regards to constraints or anything like that?
So this is not part of the test, the constraint and convention.
No, it is not part of the test. I will not ask you anything on these. Okay, I will only ask you on the first 8. Okay. All right, last section here is going to be talking about cash basis versus accrual basis. So I actually briefly talked about this very, very briefly, I believe, in chapter 1. Understanding what it's like to be under a cash basis and an accrual basis. All right. So cash basis is pretty straightforward. All transactions are recorded, or for such as income, right? They're only recorded when you receive cash. Pretty straightforward. All right. And all expenses and payments and, all your obligations, they're only recorded the day that you have enough cash to spend it. So cash basis is straightforward. When you receive cash, boom, you record it. When you spend the cash, boom, you record it. All right? If you don't have the cash, you don't record it. If you didn't receive the cash, you don't record it. Okay? That's as easy as it can be. Whereas accrual basis, they record transactions, okay, such as income, are recognized when it's earned. And how do you earn a revenue? The day you complete the task. So whether it's a good, or you provide the service, or you sell a product or goods. So that is when you recognize your revenues. Same thing with expenses. You recognize your expenses the day it happened, okay? Regardless of receiving cash. So if you received cash, great, it benefits you more. But if you don't receive cash, you still record the transaction. So that's the accrual basis. So putting it into perspective, most mom and pop shops will run on a cash basis. Most startup companies are going to be under a cash basis, okay? Bigger companies, corporations, and other things like that, they will use the accrual basis, okay? Because they allow their customers to have accounts, allow them to owe money. And how they get their money out of it is obviously, if you're a major corporation, right? You're going to be talking to credit card companies that can collect the debt for you. So, for example, Walmart. If you guys have a Walmart credit card, right? Not only do they allow you to have a credit line with them, they don't require you to pay them on time. They allow you to defer the payment. They get you more when you have to make a payment, and they charge you interest on top of that. Same thing with the idea of your expenses. You don't have to pay them right away. You can pay it on a credit card. All right, vice versa. So that's the concept here. No matter what it is, whether you receive cash or not, when a transaction happens, it's recorded. So if you earn something, or if you sold or provide a service, you record it. An expense has happened, whether you had to do remodel your company, remodel your building. The minute it happens, or the minute you receive the bill, boom, you record it, whether you paid or not. Okay. So that's the concept between these two. Now I'm going to do a really specific example, and I'm going to ask you, is it cash basis or is it accrual basis? Okay. So for example number 1, if your company decides to have a person come and paint your building, okay? Now, for a cash basis, right? The job isn't complete until you pay them, okay? Or in this case, you had the job done in January, but you don't pay it until February. So what day are you going to record this expense if you're on a cash basis?
The day it started.
No.
The day you pay it.
The day you pay it, correct. If you're under a cash basis, the rule of thumb is even if the service has been completed, you don't record it until cash is spent or paid. Okay? Where flip and reverse is, so if you're doing accrual basis, you had a job done, you had the paint job done in January, and then you paid it in February, when do you record this expense under the accrual basis? Okay, so the hint here is when was the job completed?
February.
January. So
Yeah,
again,
January.
yes, February is when you paid it. So
Paid it, right.
that's the here's the so the concept and the difference between it is one. Okay, in both scenarios, the job was done in January. They both paid in February. However, if you're a cash basis, the concept here is that all expenses or whatever that you've made, right? The expenses that you paid off for that person to do the job for you isn't recorded until you paid it with cash. Like physically pay it. Whereas in January, whereas on an accrual basis, the job was completed in January. You still paid in February. However, the whole notion here is the expense incurred in January. So therefore, you record it in January, regardless whether you paid it or not. So that's the concept there. Okay, so any questions? You need another example? Is it kind of making sense, understanding it?
Yes.
Okay, so all under cash basis, all revenues and all expenses are recorded when cash is received or cash is available to spend. Accrual basis is going to be, you're going to recognize a revenue and you're going to recognize an expense the day it happens. So revenues is when you sell a product or the day that you provided the service. And then the other one is when the job has been completed, whether you're buying an expense, regardless of payment, whether you received a payment or not, or whether you paid or not. Okay, so in this kind of case, when you earn something is going to be the day that the job, the service has been completed. So that's earned. And then the day that you've completed the expense or the expense has been done, it's going to be incurred. Okay, so yes. Now again, we're going to go over course review. So here you go. I'm just going to just briefly go over this. Here are the 10 steps of the accounting cycle. Here is the accounting period, the four characteristics of financial statements, the difference between calendar and fiscal year. Also, a little guideline here is going to be your generally accepted accounting principles, which consist of your
So, thank you.
assumptions. Go ahead.
No, sir. Somebody talk to you, sorry.
Okay, sorry. Okay. So your assumptions, your basic principles, and your constraints and conventions. And then lastly, you have the difference between cash basis and accrual basis. Okay. Now, I'm going to give you a little shortcut or a little, I guess, mnemonic device on how you can understand the generally accepted accounting principles. So just like your ABCs, you have it here. Your assumptions, your basic principles, and your constraints. Okay? Know that there's a total of 12, but I'm only requiring you to know the first 8, which is your assumptions and your basic principles, because these are the ones that you're going to be underlying the most widely used ones, where your conventions or your constraints are more along the lines of if you're doing business further on. Okay, so again, generally accounting accepted accounting principles is going to be your ABCs, your assumptions, your basic principles, and your conventions and constraints. And then for this one, I mean, I don't know how better way to say it. Just the best way to differentiate them is just that if you're on a cash basis, cash is the necessity that you need to have. You need to receive it, and you need to or you have to spend it in order for you to be a cash basis. Okay, everything else is just going to be accrual. Okay, as far as memorizing the accounting cycle, there's no real one except for cap. you know, cap, gripple. I don't know. Something fun like that, but just know that you can create one for yourself. I haven't gotten that far yet, but that's just a little key, little things that can help you to memorize this. But again, for the exam, I will allow you to have these. Okay, so just a little FYI there. So any questions in regards to chapter 4? Okay, then let's go ahead and get started with the exercises. Okay, so what is the accounting cycle?
Set of rules to ensure accuracy and conforming the financial statement.
Good. Set of rules Good. Okay, so what are the 4 characteristics of financial statements?
Reliable.
Yes.
Consistent,
Comparison.
What was the last one?
Comparable.
Comparable. Good.
Terrible.
Yes, it needs to be, this is very, very important that you are consistent and that your information is reliable. Okay. So what are the 10 steps of the accounting cycle?
Collect source documents.
Yes, collect the source documents.
Analyze and sort data.
Yes, analyze.
Record transaction
Where?
in general journal.
Yes, record in general journal. What's after that?
Goes to the general ledger.
Then it goes to the general ledger, correct. What's after that?
Unadjusted trial balance.
Not the adjusted.
Unadjusted.
Unadjusted, okay? Good. And then what comes after that?
Adjustment entries.
Yes, you need to have your adjustment entries. Good. Adjust.
And then your adjusted trial balance.
There you go. Now it's your adjusted trial balance. Good. What comes after that?
Financial statement. Create a financial statement.
Yes, that's where you have to create all 4 financial statements. What else?
And then closing the books.
Yes, you got to close the books. And then,
And
lastly,
closing trial balance.
yes, post. Good. So again, as you can see, when you do the accounting cycle, right? We talked about scheduling the accounting cycle to be completed. Now tell me, is that possible to do if you're a major corporation and be able to do it on a daily basis? You have to complete all of these steps every single time. So that's why most companies, they kind of prefer to do monthly, or they do quarterly, just because it's just easier to just compile everything up towards a given specific goal. So such as the end of the month. Again, because all of this, and believe it or not, we will go over all of this, and it's not going to be one day. It's going to take multiple days to complete this whole entire thing. Okay? All right, number 4. What is the difference between calendar and fiscal year?
Calendar year start January 1st and ends December 31st.
Good.
And fiscal year start first in the first one
Mm-hmm.
and ends 31st and 12 months, right?
Yes. So the day of first month and ends on the last day. So 31st or 30th. Okay, good. All right, what are examples of accounting periods?
Weekly.
Weekly,
Monthly.
monthly,
Quarterly.
quarterly, yes.
Annually.
Quarterly and annually. Good. Annually. There you go. Next one is going to be, what does GAAP stand for?
General accepted accounting principles.
Yes, generally accepted accounting principles. Good. All right, next one is going to be, what are the 4 assumptions under GAAP? Okay. I just want you to list them out. I don't want you to tell me the details.
The business economic entity assumption.
Yes, business. Okay, so or economic.
Or economic entity.
Okay. And then number 2,
Going concern.
going concern. Yes. What else?
Accounting period. Accounting period.
Yes, accounting period is correct. And then lastly,
Monetary.
yes, monetary. Okay, good. All right. What are the 4 basic principles?
Historical cost.
Historical cost. All right, what else?
Revenue realization.
Yes, revenue recognition slash realization. Good.
Matching.
Matching. Yes, that is definitely something that you need to remember. Matching. And then lastly,
Adequate disclosure.
yes, adequate disclosure. Okay. And then, of course, we're going to obviously ask, well, you should know at least the titles of your constraints. What are they?
Material.
Materiality.
Material
Materiality.
convention.
Mm-hmm.
Cost benefit.
benefit.
Mm-hmm.
Conservationism. And industry.
Yes, industry practices. All right, now the next question is going to be number 10. Under cash basis of accounting, revenues are recognized when
Cash.
cash, good. When cash is received, all right? And expenses are recognized when,
Cash.
yes, cash is available to spend. All right, under the accrual basis of accounting, revenues are recognized when blank.
When they're earned.
Earned.
When they are earned, yes. And then lastly, expenses are recognized when blank.
Incurred.
Incurred.
Incurred, yes. So the day it happens is when you record it. Or most cases, the best way to recognize it is when you receive a bill. Okay. And then number 12, under GAAP, which rule states that you must separate your transactions from your personal and from your business?
Business or economic entity.
Yes. Okay. So this is going to be how I'm going to ask you the question. I'm actually going to give you a scenario, and you're going to differentiate which rule am I asking you for. So this is business or economic. Good. Oops. Okay, there you go. All right. Under the rules of GAAP, which rule states that assets must be recorded at original price or fair market value?
Historical cost.
Yes, historical cost. So these are all definitions, but when we talk about going to the study guide, I'll give you examples of what I'm going to be asking you on the exam. All right, so number 14, under the rules of GAAP, which rule states that when recording a transaction, it must be in terms of value or dollar amount, okay, and cannot be
Monetary.
recorded? Yes, monetary is correct. Okay. Number 15, under the rules of GAAP, which rule states that when you have extra information that is pertaining a transaction, example, number of employees, where do you place this in your financial statements? Sorry. You must record in the notes to the financial statements. What principle do you? What?
Basic.
Which one specifically?
Um,
It is a basic principle.
the magic principle.
Not matching, that's when you have to make sure that your expenses match your total revenues. So in this case, it's not matching principle.
The adequate disclosure.
Adequate.
Yes, adequate disclosure, right? I was actually going to give you the answer to this slippingly, but yes, adequate disclosure. If you have extra information and you need to put it in the notes to the financial statement, that's exactly what this principle tells you to do. All right. And then lastly, number 16, under the rules of GAAP, which rule states that all revenues must be equal to all expenses?
Accounting period.
Not accounting period. That one's going to reflect that you have 12 months, and what they let you do is they let you break it up into quarterly, weekly, monthly, annually.
Revenue, revenue, something help me with other word, recognition, something like
Okay,
that.
so revenue recognition,
Yeah,
or it's also known as we just talked about this, revenue recognition, or also known as realization.
right.
No, that one is just when an event happens, you record you record the revenue when a service is provided or when a good or product has been sold. You've
It'd
earned
be the
it.
matching, right?
This one will be matching, yes, because
Oh,
all revenues, right? They need to match the total of all of your expenses to create your revenue. So this is going to be matching principle. Okay, so this way, you could. The hint is all revenues must be equal. Okay, to all of your expenses. Okay, good job, guys. So, yep. Since that's all we have left to do, I don't want to dive into chapter 5 just yet because it's your first week of school. Enjoy the rest of your day. Have a great weekend. I will be uploading chapter 5 on the Google Classroom soon, so everything should be up there by this weekend. So you should be prepared by Monday. Nothing is due this weekend, so you guys can have a nice, relaxing vacation and try to get yourself back into gear. But other than that, have a wonderful weekend, and I shall see you Monday.
Yeah.
thank you. Have a good
Thank
day.
you. Have a great weekend.